welcome to TheoTrade. This is Don Kaufman. August 19th, 2020. Minutes left inside of the trading session here on a Wednesday afternoon. The S&P's seeing some mild sell side activity. Of course, most of that is being generated specifically inside of the Nasdaq, which once again, the bidless beast rears its ugly head in the Nasdaq. This is quite the drop inside of the Nasdaq after the FOMC minutes came out today. Spooked the market a little bit, and just to kind of give you a feel for what was a very brief period of time. But yeah, that's a drop of close to 130. Again, 130 Nasdaq handles in a very, very short period of time. Hence, us calling it, of course, the bidless beast. But I think the bigger thing, really, in play today is with some of this mild sell side activity. And people, come on, that's all it is. I mean, the S&P is hitting an all-time high yesterday, so they're slipping by a tune of 0.5%. But I'm getting emails and already getting questions. Is this it? Is this a warning shot? And I'm going to detail a little bit of that and really some positions you can take around that logic here on this evening's video. Let's get to work. One of the things that's a real standout for today's trading session isn't the fact that we sold off. Okay? Yes, the Nasdaq is obviously leading it, but hey, net, the Russell is massively unchanged for the session. The point being over here, if you take a look at the advanced decline line inside of the S&P 100, and I've been mentioning this almost ad nauseum lately inside of the S&P 100, the advanced decline line, listen, we're absolutely nowhere near a correlated state. And I've told you time and again, you'll know when this marketplace is selling off when you start to hit high degrees of correlation. In fact, when you start to look at different asset classes, today there's more questions than answers. And I say that simply because, all right, so yeah, the S&Ps are down, but we're not correlated here. The S&Ps are down. Volatility came up, but volatility came up what I would actually call a fairly minimal amount. I mean, specifically these volatility futures. Listen, again, you're going to know when there's real sell side activity because the volatility futures are going to be a rocking out there. So you're not in a correlated state. The volatility futures are not exactly rocking out there. You know what? As you look down the list of the usual suspects, you've actually got bonds selling off a little bit. The interesting thing, though, as bonds are selling off, it is not helping the financials. The financials have been, throughout the course of today's trading session, that's been actually your stronger sector. It's started to slip as well after those FOMC minutes, but that was really ultimately getting dragged down by the Nasdaq. And again, little bit of correlation starting to kick in, but nothing necessarily to speak of. So the other aspect that I think that begs to be looked at is, of course, when we're talking about lack of correlation, the S&Ps are down, again, nominally. Apple still up on the day. There's a few of your, again, major players, including Goldman Sachs, of course, one of the bank stocks that's up on the day. Costco. Again, it's a real mixed bag of goods. What is really leading the sell side activity? Okay, be very, very specific over here. You just got to start to point the finger towards Amazon, which, again, has had some just incredible trading sessions back to back. And a few of the other monsters of tech, including, of course, Microsoft. Other than that, okay, we don't want to start to say, like, that's it, this is the warning shot. However, at the exact same time, okay, one thing that I've come to the conclusion on, and this is strictly an opinion, I guess, piece over here, is got a minute to go to the trading session. This marketplace, I think a lot of traders are looking absolutely at different types of technicals. And I'll just make a kind of a quick point with some of the technicals over here. This is an RSI Laguerre. Of course, this is a wildly overbought situation. The fractal energy is starting to come up a little bit from an absolute rock bottom number. But we could pull up umpteen different studies. We could look for MACDs about to roll over. Again, I could legitimately spend hours talking about some of the technicals in here. Quite frankly, I think all of it's for nothing. And at this point in time, I think you have to realize not only have we had, okay, just an incredible and stellar move to the upside. The problem, though, going forward is the market is not going to start to wave red flags at you. And this is something right at the closing bell. This is something that I've got to not only reiterate, sorry, I've got other platforms running in the background. I've got Tastyworks running in the background. I've got, thinkorswim running over here, different types of closing bells. The point being of me getting into this marketplace is not going to wave red flags. And this is a perfect day to have that discussion. Again, it's kind of a mild sell-off, and it's interesting to see. Again, we have over 6,000 clientele now here at TheoTrade. I'm getting flooded with emails already. You're like, is this it? Is this it? Okay, as I said, it's not going to wave a red flag. But the one thing that I will promise you about this marketplace is when people start to move for that door, you got a crowded room here, and this is an incredibly crowded trade. When they start to move for the door, it will get too serious too quickly for you to be able to exit a lot of long positions. So out of all of this, okay, tonight in discussion of, well, we're not correlated. Listen, we're not going to wave flags at you when the market's going to sell off. When it's ready to sell off, it's going to come down. It's going to come down in a hurry, okay? There's going to be some violence inside of that trade. So if you were long, when I'm talking about long, I mean, I'm legitimately talking about like 401ks. Like, you got to realize that even though the housing market right now inside of the U.S. might be stellar in some locations, probably hideous in other locations, nevertheless, everything feels like wonderful. 401ks, as I said, the risk inside, okay, of this marketplace right now is absolutely pivotal. And the reason I'm saying, for a 401k and that the risk is pivotal here, you have to realize that the economy, okay, is, absolutely unequivocally weak. We know that. The unemployment is high. There's a lot of programs going on. But you have to come to the rationale. All we have to have is just a quick burst to the downside in the S&Ps to devastate 401ks. All of a sudden, then, everything comes apart. And you can actually, you can draw a lot of relationships of this back to like, here, I'll go even back all the way to the Depression in 1929. The economy was already taking some serious heat before the market came down. In this particular circumstance, and by the way, I'm not trying to draw a conclusion from one to the other, but in this particular circumstance, all it will take is a little kick in the pants to the marketplace for everybody. All of a sudden, okay, the tide will turn. And that's where I'm saying there's not going to be any flags being, waved out there. And this is not me giving you a suggestion. You need to get short. Listen, if you want to participate, which will be eventually some downside in this marketplace, today, tomorrow, a couple of months from now, people are calling for the election already. That one is never late. But if you want to participate in the downside, the marketplace is not going to start to sell off and then allow you to participate in the downside. You will either be in this as a short or you will not. And the types of trades, and this is where I'm going with this, the types of trades that you have to look at, okay, for activity like that, you're going to look to place maybe some outlier type trades, things like in the spiders. But, what's at issue in the spiders and really a lot of the index products, and you start to look over here, it's 20% vol, 20% vol, 20% vol, but go ahead and open up a couple option chains. Like, seriously, go ahead, go open up like a 30-day out in an option chain and open up just a ton of strikes. And in one of the information columns, whether you're here on, thinkorswim or whether you're, over on Tastyworks, pull up implied volatility, okay? And I want you to take a look at what's termed skew. And I'm intentionally just going 30 days out to make just a quick point over here. When I say that I'm out there and I'm talking about skew, what I'm referencing is, yeah, this says 23% implied volatility, and yeah, the at-the-money implied vol is about 18%. But as you go further out of the money, what you have to understand, the marketplace is already pricing in tail risk. Okay, this is not a perfect distribution curve. There's a wild tail down here, and that effectively means that if you're out there buying puts, you're already paying up. Like, you're paying up and paying up big. So that is not going to be effective. And by the way, when you go further out in time and you start to reference the election, look at the jump in implied vol out here. Okay, the market already sees it. Like, the December options, these options, come on, they're just wicked. I mean, literally, they're like 30% vol. You start going out of the money a little bit here. And again, we are so far out of the money. This is like the nosebleed seats out here, okay? But they jumps all the way to like 40% implied volatility. And you go, there's no way that we're getting down there, really? Because the marketplace is actually pricing that. So I actually succumbed to the fact that I had to try to find a product that had a high correlation to the spiders, okay, to put a trade on. And this was actually originally driven by a client email. This gentleman emailed me and he said, you know, we could take a look at the HYG. And inside of the HYG, what I'm doing in the HYG, and by the way, this is, what is it? It's junk, okay, junk bonds. I'm actually pulling off an RTS spread, which stands, okay, for a risk twist. What a risk twist does, a risk twist takes, okay, the wild outlier shot to the downside. And should there be a wild outlier shot, and in this case, I jumped all the way out to the December expiration today, and I've already executed the trade. Okay, if there's a wild outlier shot anytime between now and December, first of all, the trade is just such a nominal cost. It's like, why not do the trade? Okay, paying a couple pennies for this just huge outside shot. And if there is that huge move down anytime between, you know, now and December, this thing will pay off in spades. And so why did I go to HYG? And that partially goes to, and I'll come back to the option chain here and then I'll cruise back over to the charts, but I went to HYG simply because the implied volatility is drastically lower. Okay, and you can see again, I've already got the positions on out here in December. I fired, you know, a bunch of those trades out. But when you start looking at HYG, you come over here to studies and we go to add study. Okay, go compare with. All I want to do is put in a symbol and I'm going to put in the spiders. Okay, take a look at ultimately, okay, the correlation between these two. And what I wanted you to see is that right here, this is the spiders. Okay, right up against the junk bonds, and they're moving almost in perfect relative tandem. So if the spiders are going to make that wicked move to the downside, I believe junk is probably also going to make that move to the downside. I know that people, junk, the Fed's involved in junk. The Fed is involved in junk, okay? But they're doing very, very minimal things right now inside, okay, of that particular marketplace. Hence, the volatility is inherently low. Okay, at least at this point in time, giving us a great opportunity and a great shot to the downside. These are the kinds of trades, okay, that you're going to have in place. You know, again, I can't tell you, and I'm not here to try to handicap. What are we going to do tomorrow? What are we going to do the next day? Are the spiders going to sell off over here? And that's one of the reasons I'm recording this evening's video, is specifically to tell you, yeah, maybe that was a warning shot across the bow. But personally, I don't think the marketplace is even going to give us a warning shot. I think one day you're going to wake up and you're going to be in the middle, okay, of a hideous marketplace. It's not going to roll out a red carpet this time. I mean, this move to the downside, it's a red carpet. I mean, literally started to flinch to the downside. We got a bid back under it. I was able to put on RTS spreads half the way down because volatility didn't pump into this, right? It was like Christmas for multiple days in a row to the downside. This one, that's a big question mark. It's not going to roll out a red carpet. Okay, when we go, you're going to know it. But you're not going to get, again, you know, warning signs prior to. Hence, we're back to the risk to a spread. We're back to that long shot to the downside. You're going to pay next to nothing for it. Okay, and if that event arises, again, you have to be positioned prior to. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.